Once again, good morning, everyone. Thank you for joining us. Mark Contra at the Messer office. And again, this morning, we're going to bring to your attention information on a particular carrier's products that I think you're going to find most useful. I think it's the wave, and I think you're seeing it already, of the future of life insurance. A couple of housekeeping information points for us. Just number one, make sure that phone is muted, just in case any sound could sneak through. We're going to ask that the questions that you have, you save until the end, or we're going to save until the end, by having you type them into the question box that's on the screen on the right-hand column. That way, some of the things that you may want to ask questions about perhaps will be answered anyway during the presentation. Ask you to stay with us until the very end to review the information as well as to discuss a bonus that will be available for the participants on this call this morning. With all that in mind, it's my pleasure again to welcome the Regional Vice President and National Trainer for American General Partners, Mr. Walt Scheid. Walt brought this information to us late last year. We've been all over it since then, and improvements on it today that are going to be brought to our attention. Walt, good morning.
Good morning, Mark. Thanks for the introduction, and I appreciate everybody taking a few minutes here to spend with us as we talk a little about our products and some things that have changed. Today, I'm going to do a number of things. First, I want to talk about the accelerated benefits and some changes that we've made that make the product, the riders, even more competitive than they have been in the past, and give your clients actually access to more of the death benefit than they've had in the past. I'm also going to touch on a couple of the products that we have and some updates we've made to them. And to be honest with you, I'm not going to go into great detail on a lot of it. What I want to do is just kind of expose you to it and perhaps pique your interest a little and see if we can't have you call in and get some more information on those. So with that, we'll go ahead and get started. And I am going to talk about our quality of life select choice 2 riders that are available on the products. They're all accelerated benefit riders, and what's happened is we've made some updates to those products. I can get my screen to change. There we go. And living benefits really are of value to your client. They help cover the costs for chronic, critical, and terminal illness. They can provide peace of mind during difficult times. And, of course, they can help your clients maintain their quality of life. If you think about it, when someone suffers some type of an illness or a long-term care type event, that requires or can require a fair amount of cash. By having access to the death benefit and being able to accelerate portions of that and use that cash can certainly help a client stay in the same place they were, if you will, without having to deplete other resources. Now, all of our products carry the additional riders built into them, and there is no additional premium cost. And I just want to take a second here and mention this, and that is that every product we sell, whether it's a indexed universal life, a fixed universal life, a no-lapse guarantee or a GUL tech product, even our term insurance, every one of those products includes the accelerated benefits built into them. Furthermore, there's no additional premium, and really one of the things that I think separates us from a lot of the other competitors out there is that there's no underwriting for our accelerated benefits. Probably the easiest way to describe that is that, we will issue policies up to Table P, which is an exceptionally high rating. If someone actually was issued a policy, Table P, and they accepted it, they would have the accelerated benefit riders on their product exactly the same as someone who's Preferred Plus. So, regardless of their underwriting class, it's a great way for you to provide additional benefits to your clients. Now, let's talk about some changes that have happened in our accelerated benefit riders. Currently, with our new product, you can accelerate up to $2 million for a qualified critical, terminal, or chronic illness. Prior to this, the accelerated amount was $1.5 million. So we've added an additional $500,000 that the client can now access. for use when they have one of these events. Now, the total amount that can be accelerated over all policies is $2 million. $2 million. And the reason I say that is because sometimes people will think, okay, I've got three $1 million policies, I can do $1 million on each. Well, we do it as an insured basis. So if an insured has more than $2 million, $2 million is still the most they can accelerate. And by the same token, if they have a $200,000 policy, $200,000 is of course the most that they could accelerate there. We also do our accelerated benefits on a discounted basis. Now, when you look at accelerated benefits, there's really two ways to do it. One is that you charge someone a premium for it. And when you charge someone a premium for it, you would typically underwrite that particular rider. Since ours are not underwritten and we do not charge a premium, we use a discounting method. And what that really says is that the more severe the incident, the more amount of money you will receive from your acceleration. Okay, so in other words, if, for an example, if you have a 40-year-old female and she has stage 4 breast cancer, her life expectancy will be impacted pretty heavily. She would receive a much larger benefit than, say, a 50-year-old who had a mild heart attack. Both had, critical illness events. However, her breast cancer was much more severe. So if they both asked for $100,000 of their death benefit to be accelerated, the female would receive more because it had a bigger impact. So what happens is you get a discounted amount, and I'm going to show you some charts in just a second that will help clarify kind of how that all works. The other thing we've added to our accelerated benefit riders is a guaranteed minimum. So regardless of how severe or how mild, if you will, the event was, there is some minimum amount that you will get if you accelerate a portion of your death benefit. We think it's important that people understand that they can always get something if they experience one of these events, regardless of how severe it might be, and that they understand what that is. That's why we've included the guarantee on these. And as always, this is an indemnity benefit, which means that you don't need receipts. You can spend the benefits on anything you like. We don't require any receipts for medical expenses, or if you're using a chronic illness, any nurses or anything like that. We will provide you with the cash. You can do with it as you please. If you want to pay your medical expenses, that's fine. If you want to do something else with it, you can also do that. So let's talk a minute about chronic illness. And this is an illness or condition that is certified by a physician, and basically it revolves around the activities of daily living. So if you cannot perform 2 of the activities of daily living, you would qualify under the chronic illness. Another way to qualify is if you have what we call severe cognitive impairment. And basically that means that someone needs to keep track of you to protect you from yourself or for other people from you. Think in terms of Alzheimer's or dementia or something like that when you think of the severe cognitive impairment. Pretty straightforward. Basically, it works a lot like long-term care. The one thing we used to have was a permanency requirement. In other words, you had to be a permanent type of event. We've removed that. So your normal things like the example I always used to use was someone skiing down a mountain. Okay, I don't ski. Let's say I decide I'm going to take a double diamond down a mountain in Colorado. And I get to the bottom, but on the way I hit not 1 but 2 trees, and I break both arms, both legs, and my back. Well, I'm going to be laid up for a couple of years probably rehabilitating. With the old definitions, it would not qualify. Today it would, because that illness is not permanent, but yet I still can't do 2 of the 6 activities of daily living. So we think that that, again, has made a really big difference in the way that this rider can help the clients. And here's a chart that shows the payouts, and this is included in all the illustrations. And you'll notice that, I've got to get this out of the way here. You'll notice that when you look at this, there are 4 different categories. You've got minor, moderate, and severe. And based on those is what the payouts will be if you file a claim. You'll notice the older you get, the higher those amounts become, and of course the guaranteed amount is always the smallest. This is included in every illustration, and you can see it, the client can see it when you show them that illustration. Now, a chronic illness, this is a different type of thing. I call this more like the dread disease type of rider. You can see the types of qualifying critical illnesses that are there. You'll also notice that invasive cancer is shown rather than listing out all those different cancers like leukemia and those types of things. You can see that you have 365 days, and what I didn't mention so far is that our waiting period for each of these is 30 days. So for the chronic illness or the critical illness, it's 30 days. Now, I forgot to mention on the chronic illness, there's a 90-day waiting period, typical as you would see with anything else. So if you bought a policy today on the chronic illness, you'd be able to file a claim in 120 days. With the critical illness, you can file a claim in 30 days. The only exception to that is invasive cancer, because invasive cancer many times is much more difficult to diagnose and won't show up as quickly. But again, if you bought a policy today, in 90 days you find out you have leukemia, you could file a claim. Many of our competitors will make you wait up to 2 years before you can file a claim, and that doesn't do you much good if you have a claim early on. As a matter of fact, the very first claim that we had occurred with a female who had breast cancer, and within the first year of her contract, she had been diagnosed with breast cancer, accelerated her entire policy, and before the end of her first anniversary, she was given $80,000 of her $100,000 policy in cash that she used to pay for her chemotherapy treatments. Now, also with the critical illness, we show a graph depicting examples of the acceleration you could receive. You can see as you get older, the amounts of the payout are higher, except really for the severe level. The severe level is pretty high. I want to draw your attention to the difference between normal critical illness, if you can call it that, versus invasive cancer. The invasive cancers are much higher. The reason for that is simply because they tend to have a much more significant impact on someone's longevity. Finally, we have a terminal illness rider. And a terminal illness rider really says this, that you have 24 months from the date of diagnosis to live. It's significant in that when you look at different carriers, their terminal illnesses may vary from you're expected to live 6 months, 12 months, or up to 2 years. 2 years is a very long period of time. Back in the 80s, when terminal illness riders were first introduced, most of them were at 6 months. We're currently at 2 years, and you can see on the chart, it shows the payouts for those. You'll never get 100% of your death benefit, and the reason for that is because even if you're diagnosed as being terminally ill, there is a chance that you could live for a certain period of time. Now, one of the things that people always ask me is they say, well, I accelerate $100,000 in my death benefit, but they only give me 50% of that. They give me $50,000 of the 100 I accelerate. And I've come up with what I think is the best way to explain that to people. If you buy a life insurance contract, when that person dies, we will pay the entire death benefit to their beneficiaries. Basically, with accelerated benefits, what's happening is you're saying, I would like to have my money today. And let's say that you bought a policy when you were 40 years old, and you're 50 years old now. When you bought the policy, we thought your life expectancy might be 86 or 88. Let's say you were a preferred risk. What you're saying is, I want the money today at age 50 instead of 86. So that means we discount it. That's why we don't provide you the full amount. And here's the best way that I've come across to explain this to a client. If you ask a client, if you buy a savings bond today, a 20-year savings bond, and in 10 years, you cash that savings bond in. Are you going to get the full amount? And most everyone would know, no, I'm not going to get the full amount. And the question is, well, why won't you get the full amount? And the reason is because it didn't mature. I didn't hold it for the period of time I was supposed to hold it. The same thing holds true with accelerated death benefits. Instead of waiting until you actually die at some point in the future, you're telling the company, I want you to pay me my death benefit today. And since it's happening early, there is discounting in that. All right, let's move on. And I want to talk a little about a new rider that we have called the Accelerated Access Solution. This is different than the riders that are built into the contract. The three that I just talked about are built in, have no cost, or included with every policy. This one is different. This one is actually underwritten and has a premium. The big difference between the Accelerated Access Solution rider and the three riders is that there is no discounting. When you pay the premium, you're basically paying to eliminate the discounting on the rider. So if you ask for $100,000, you get $100,000. Now, this is basically a chronic illness rider, works very much like long-term care, but it does not require a long-term care license. Again, it works like typical ones do, 2 out of 6 ADLs or a cognitive impairment. One of the things that separates us, of course, is that it's an indemnity benefit. You don't need any receipts. You can spend the money on anything you want. And then finally, we have a flexible benefit base. You can choose how much of your death benefit you want to purchase, anywhere from 50% to 100% that you can accelerate with a $50,000 minimum. Now, the maximum on this is $3 million. So if you had a $3 million policy, you could accelerate the entire amount for a chronic illness. And while you're under the claim, the cost for the rider is also waived. Now, one thing that really makes us different is you can choose how much of your death benefit you want to accelerate. You can choose 2% per month, you can choose 4% per month, or you can choose a number that's equal to the IRS per diem with no caps. You'll notice at the bottom of the screen, we show exactly what the per diem is for 2016. It's about $340 a day, or about $10,300. So what happens is, if you purchase today's per diem limit, you'll get whatever it is today. If you choose the 2 or 4%, you're going to get the 2 or 4% up to the per diem. Now, the big difference, again, is that most people won't allow you to choose different levels. By being able to pick different levels, you basically can build in an inflation hedge to cover monthly caps as they might change as the government states them. So, for example, if we chose a 4% cap, and let's say we had a $300,000 policy, that means that should you go on claim, you could collect $12,000 per month. Now, what would happen in 2016 is, even though your benefit is up to $12,000, you would collect the government stated per diem, which is a total of $10,341.66 a month. Now, let's assume that you went on claim in the future. And let's say in the future that the per diem was $15,000. At that point, you would be able to claim the full $12,000 because the per diem is higher. Now, if you still had a $300,000 face amount, and let's say that you had chosen the maximum benefit, the daily per diem, again, the maximum you could get is what the government allows, is $15,000. All right, so that's kind of a quick overview of what's changed with the accelerated benefit riders. One of the things that we're most excited about is we've made a pretty significant change to our indexed universal life contract, which of course includes the built-in accelerated benefit riders and has the accelerated access solution rider available as an option that you can buy as an additional rider. Now, what we've done with the QOL Max Accumulator Plus is we've tried to incorporate the best ideas we could to create a product that is designed really to accumulate cash value. You know, in today's marketplace, so many people are concerned with saving money for retirement, and the problem they face many times is that they don't have any other place to do it. Maybe they've put in all the money they can in a 401k, maybe they've maxed out their IRA or their Roth, and they've got no place else in a quote-unquote government-sponsored type savings plan where they can put their money. Life insurance is a great alternative. And let's talk a little about the product. And really the heart of the product is the indexed options that are available. And I want you to ignore the far right column, and I know you're all looking at it right now, but I'll come to that at the end. We have basically 4 different indexed options you can choose. The first one we call the blend participation rate. And what it really is the Merrill Lynch Strategic Balance Index. This index is new and it's proprietary to us. No one else has access to this particular index strategy. And the goal of this strategy really is to provide diversification to the client. And it's to control the volatility. You know, when you look at what happens in the marketplace, the market goes up, the market goes down. And while these are index products and they never lose money, you know, wouldn't it be nice if we could earn some interest credits when the S&P is negative, right? It's great that we don't lose money, but wouldn't it be great if we could earn a little interest? And that's really what this is about. It's designed to control the volatility or changes in the marketplace. You can see that it has a participation rate of 100% and it has no cap. Currently, it's illustrating 7.38%, and that's under AG 49, which are the new illustration rules. Those rules say that everybody has to use a 25-year look-back. The next one is the participation rate, and this one's a little different than what most other people offer. On this particular indexed option, we say you get 65% of whatever the S&P does. So if the S&P does 10, you would get 6.5. If the S&P did 20, the policy owner would receive 13. And so there's no cap on this, and so in years when the S&P does really well, the client is also going to do really well. They're going to get 65% of that. And that's demonstrated by looking at the 25-year look back. On this particular one, it's 7.35%, almost the same as the Merrill Lynch. Now, the other one is called the high cap rate. And really, the high cap rate is something everyone's familiar with. And by the way, all of these are a one-year point-to-point, meaning if you buy a policy January 1st, we're going to see what happens to the S&P from January 1st to December 31st, and then credit you interest on that. The high cap rate has a cap of 13.5%. You'll also notice that it has the highest illustrated rate of 7.47%. It's pretty straightforward. Of all the money out there in the industry, this is where most of the money goes because it's probably the easiest to explain to people, and for most insurance companies, it tends to be the default. Now, a new indexed option we have is called the core cap. And the core cap is a little bit different than something perhaps you've seen before. This one is designed for that client who says, gosh, you know, all this stuff about these high interest rates, I don't think that's right. They're more conservative, and so this has a cap of 10%. And you'll see that on a look back, it's illustrating at 6.11. The other reason for this rider is a lot of people like to change the interest rate on index policies and compare them at a lower rate. And so by comparing them at 6%, then you get some feel for how the product works. This index option was designed specifically for that. It's going to show a lower interest rate, but it's also a more conservative rate that's going to fluctuate less. Now let's go to the last column, and this is something new that we've also added to these products, and it is a current account value enhancement, and it starts in year 6. And that's significant because most companies don't start account value enhancements, as there are other companies that offer those, until year 10, 15, or sometimes year 20. These happen very early in the process. you'll notice that the core cap, the one at the bottom, has the highest account value enhancement. So what you need to understand is that in year 6 plus, that policy will actually be illustrating 6.86%. That's the 6.11 plus the 0.75 account value enhancement. You'll notice that the high cap rate, the 13.5 cap index option, actually has the lowest account value enhancement because it has the highest illustrated rate. Now the Merrill Lynch has the second highest account value enhancement, and it's actually going to illustrate at 8.03. This is the index option that over the long run will probably provide the highest returns because it eliminates volatility. And let's talk a little bit more about that particular indexed option. That particular indexed option includes 3 different elements. There's not someone sitting around saying, gosh, we need to move money here or move money here. It's all based on rules, and they happen automatically. So when you buy one of these policies, initially the money is going to be split between equity, which is the S&P 500, and a fixed income bucket, which is the Merrill Lynch 10-year Treasury futures. Now, I say that, and it's important to think about futures. With this particular index option, we're looking into the future, and we're picking up interest rates that are happening in the future. Most people would agree that interest rates are going to tend to increase as time goes on, so you're taking advantage of that in the current day with this particular option. Now, the way that it controls volatility, as I said, is trying to eliminate those big variations in the marketplace, is it can move daily between equity, fixed income, and cash. As a matter of fact, it can go 150% over in either one. So let's say that the S&P is doing really poorly. Well, it could move money out of the S&P to basically capture what gains it's had and move that money into cash. It could also move money from cash into fixed income so that you're taking advantage of a fixed interest rate while the S&P is performing poorly. So basically what it's doing is it's helping to create a more level and stable rate of return for the client over the long term. And this chart probably describes it best. And I want to draw your attention really to 2008 right here. And you'll notice in 2008, the S&P was down, oh gosh, almost 38, 39%. And while you didn't lose any money in your product, you wouldn't lose any money in your product on that particular instance, you probably wouldn't get interest in any of the other index options. But you'll notice, although it's not a lot of money, the orange line here does provide a little bit of interest, 1 or 2%. So in the old days, it used to be that 0 was the hero with index policies. Market goes down, you're not going to lose money. Now, the phrase is something is your hero rather than 0, because the idea is to get some interest credits in those down years. And you can see back here in 99 to 2002, the same thing. S&P down each one of those years, yet you earn some interest credits in those years. And that's really the basis behind this. It's to help smooth out all those fluctuations you see in the marketplace, so over the long run, the client earns a little bit more favorable interest. All right, also included in our new product, and this is something that's kind of interesting. When an individual dies, the death benefit is paid to the beneficiary. It's income tax free, and it's paid in a lump sum. However, not all beneficiaries are prepared to deal with the money they receive from a death benefit all in one lump sum. We have an option that we've included in this policy, and it's called the Select Income Rider. And basically, with the Select Income Rider, there's no cost. And what it does is it allows the individual to defer a portion of their death benefit and make it paid out on an annual basis. And what's really interesting is that you can choose the amount of your death benefit, 10% up to 100%. And you can choose how long the beneficiaries receive their payment, 10 years, 20, or even 30. So think of it this way. Let's say that you had a $500,000 policy. You could set it up such that 50% of the money would be paid in a lump sum, $250,000. You could also say, I want the other $250,000 paid out over 10 years. So that means that the beneficiary would receive $25,000 a year for 10 years. And that does a couple of things. One, it spreads the money out so that the individual can't spend all that money at once if you're concerned about that. This can be real handy with children or with individuals who perhaps have not handled money much in the past, so that they don't spend it all or be taken advantage of by family members, that type of thing. So it's a way to control those distributions. The other thing that happens with this particular rider is this. When you make that selection to extend the payment to the beneficiary, that is made at the time of issue, and you can't change it. It's irrevocable. And the reason is because we reduce your cost of insurance when you select that rider. Because we don't have to pay it all in one lump sum, we don't have to charge you as much for the policy. So here's an example of just a comparison between our product and some others. And the details aren't as important as you can see that our income's 140, and then we've got someone close behind us at 137. And I never show these to say, oh gosh, we're number one or anything like that. I show these really just to say, look, the product's competitive. If you go out and sell it, you can be rest assured that your client's receiving a good product. Now let's look what happens. Remember, 140,000 was income. Now I put this rider on it that extends the payment to the beneficiary. You can see that my income went up by $4,000 a year. And that's really a reflection of the fact that I've reduced my cost of insurance within the policy because I chose to have the select income rider included. And I just show this to you to show that there is a real value to the policy owner if they're looking for cash in this. Whether or not it's appropriate for the beneficiary is really something that the client will have to decide for themselves. One other new rider we have is our income for life rider. And the question is, what's better than income for life? Tax-free income for life. So the way the tax-free income for life rider works is it has issue ages from 0 to 75, and you've really got to own the policy for 10 years before you can use it. You can't be younger than 55 because we don't want to pay this forever, nor can you be older than 85 because it's probably not a great deal for you. It's automatically included on every policy, and what happens is it gets triggered at some point in the future. And at some point in the future, after age 55 or before age 85, you say, I've got, $300,000 of cash value in this policy. I want to convert it to income for the rest of my life. At that point, we'll make a calculation and we will make a charge for the rider. But then once that happens, you are going to receive income for life. And really what happens is those are loans we are making against the policy. And should we extinguish all the value in the contract, we will put money in the contract so that we can make the loan to you. In addition, there will always be some residual death benefit. Because we're making loans, there'll be some death benefit. The minimum will be the corridor amount. So there will be some payment to a beneficiary at some point in the future. By doing that, these are loans, so they are not taxable so long as the policy stays in force. And you can also see that you can also purchase additional cost of living adjustments so that amount goes up each year. Now let's take a look at what that looks like. If you take one of our policies, and let's say you use the Merrill Lynch index, and you just decided to cash flow that policy. In other words, at some point in the future, just take money out. You could cash flow $95,406 a year. Now, you could run out of money if the index doesn't perform as well as it's supposed to, or if you took more money than that, you could run out of money, but you could cash flow that according to the illustration. If you included the select income rider and extended the payment to the beneficiaries, you can see your income would go up by about $3,000. Now compare that to income for life. The income for life is about half of what you can cash flow. But the thing I want to point out is that this is guaranteed. And it's guaranteed for your life, not for just some period of time. While it may be a lower amount, it does provide an amount of surety and certainty to the client. And if you took the income for life and then extended the death benefit to the beneficiaries, you'd raise that income by about $1,000. Now, I show you these just to get you thinking a little bit about the different options that are available and the different ways you can utilize the product. As you look at them, think a little about your clients and what might be worthwhile to them as they think about how to utilize these products in their own activities for planning. Now, we also made a change in our Guaranteed Plus UL. This is a no-lapse guarantee policy. You can guarantee the policy to age 121. It's especially competitive for clients age 55 and up. It's targeted to be most competitive at age 105. So in other words, guarantees to 105. But it works across all the different ages and the different durations. 10-pay is probably the most efficient way to do it. You can still do single pays, but they're not quite as efficient. And we have the addition of the Accelerated Access Solution rider on it. And probably the thing that's gotten the most attention of anything on this product is that now there is a return of premium rider built into this contract at no cost to the client. Basically, what the return of premium rider says is this. After 20 years, if you've owned the policy for 20 years, you get 50% of your premiums back if you surrender the policy. If you own the policy for 25 years, you get 100% of your premium back. And let's see what that looks like. Here's a typical illustration, and you can see that suddenly in year 20, 50% of the premium is available as a surrender value, and at year 25, 100% of the premium is available as a surrender charge. So a person can actually surrender that policy and get the entire premium they've paid returned to them. And this creates some interesting scenarios when you talk about return of premium. It may not always be in your best interest now to buy one policy. You may want to buy two, and I'll show you an example of that in just a second. Now, one thing that we've had in our products and continue to have is our Lifestyle Income Solution rider. It's really longevity insurance. And what it does is it allows you to take your death benefit and turn it into cash. You can take 10% of your death benefit per year. The primary requirement is that you're age 85. That's where it maxes out at the maximum benefit. And it's going to be tax-free to basis. After that, it's ordinary income. Now, the question usually comes up, well, gosh, why would I want to wait till I'm 85 to get the money? Well, the key here is that this is kind of a backstop or a safety net, if you will. Someone plans for retirement and they put money away, and what happens if their returns weren't enough? Or if when they're in retirement, gosh, I've got to put a new roof on my house, I need to buy a new car, my kids need to buy a new house, my grandkids have come to me for money, all of a sudden money you've got earmarked for income may be spent somewhere else. By having this rider, you have the ability in the future to provide yourself with an income to compensate for things that may have happened during your accumulation or even in your distribution phase when you're taking money in retirement. It'd be really nice to know that you have an option to take cash from a different source that you hadn't planned on should you encounter problems while you're in retirement. And here's basically how it works. You can see that at age 86, we trigger the rider in this particular policy, and they're taking an income of $100,000 a year. It was $1 million policy. And you'll also notice over here that the death benefit goes down each year, but if the person started taking income, and let's say they took income for 5 years, there's still $500,000 here. Should they die, that money would be payable to their beneficiaries. All right, now, when you look at the no-lapse guarantee, again, I don't show you these to say that we're number one, just that we're competitive. What I want to draw your attention to is here, you can see that we are not number one in premium. We're about $100, I guess, more than Nationwide. But I draw your attention to the boxes at the side. You'll notice that they don't have chronic, they don't have critical, they don't have return of premium, and they have no cash values. With our contract, we've got chronic, critical, return of premium, And we're the only company, look on the chart, we are the only company that has a guaranteed cash value. Yes, our contract, most guaranteed ULs do not have a cash value. Ours does. And that makes us a lot different than everybody else and gives your client some options in the future that they might not other have. And here's another one. Again, you can see we're not number one, but we're within $100 of being number one. But again, the ones at the top, no chronic, no critical, no return of premium, no guaranteed cash value. So when you look at a product, there are things, certainly the premium is important, but also look at the other elements. Do you think it's worth $100 to have chronic, critical, and return of premium? Yeah, I think it would be. All right, here's a real quick example, and we're about out of time, so I'm going to cover this real quick. Basically, we've got a guy who's 45 years old, and he wants $1 million of coverage. He's not sure he's going to need $1 million forever, but he needs it right now. And he doesn't like a lot of risk, so he'd like a guaranteed income source sometime in the future when he retires. He's also concerned about the costs should he become chronically ill. So we could do a couple different things. We could sell him term and a SPIA. That would take care of the death benefit and the income. We could sell him a GUL and a deferred annuity. Again, we take care of the death benefit and income. Or we could sell him a long-term care policy. That takes care of his chronic illness. But how about if we did this? Let's say that we bought him a guaranteed UL policy. 20 years, the premium's $230,000. If we had the lifetime income solution rider on it, starting at age 76, he could take an income of $60,000 a year for 10 years. If he waited till 86, like I talked about earlier, which is the maximum amount, he could get $100,000 a year. So there's two options. All right. Let's look at option 2. In this case, let's buy 2 policies, each one $500,000. Now look what happens. 20 years, he's going to pay a little bit more. He's going to pay $247,000. It's about $800 a year more he's going to pay. But now he's got 2 different policies. Policy 1, he could take from 76 to 85, $30,000, or he could wait till 86 and take $50,000. The other policy, he could do the exact same thing. But what I want you to think about is this. What if he triggered one policy at age 76 and took $30,000 a year in income? And then the other policy, he waited until he was age 85 and he took $50,000. Well, what did we just do? We just guaranteed him 20 years of level guaranteed income. Much different than if we'd have just sold him one policy. So thinking outside of the box can do some different things. What we did is we gave him this full $1 million, and we gave him a flexible guarantee of income. And not to mention the fact that he could have taken return of premium on either of the policies. So let's say that the first policy, after 25 years, he takes his return of premium and gets all his premium back. He could turn around and take that money and put it into the policy that's left and never pay another premium. So there's lots of options when you talk about the income rider and you talk about the return of premium rider. It opens up a lot of different things. So you've got lots of flexibility, and as a planner, the biggest thing you can do is provide your client with options at some point in the future. We don't know exactly how much money they're going to have. We don't know exactly how much money they're going to need. But by having cash available to them in different methods or different ways to access that cash gives them a lot of options. So all we have left now are these great disclaimers. All right, so at this point, that concludes the specific explanation of the products, and I'll turn it back over to Mark for any questions that we might have.
Well, thank you very much again. And ladies and gentlemen, I'm sure as you sat through the information today, not only did you find it interesting, but you may have felt a little overwhelmed looking at it, and that's okay. First of all, this entire presentation has been recorded. You'll simply go back to the Messer website, to our Agent Resources tab at the top, open up the drop-down box and go to the Learning Center, and Rebecca will have posted this presentation probably by sometime tomorrow. So you'll have it to go back to and take it apart piece by piece. Again, I think the most important thing to look at just to begin with is why this differs from the old type of life insurance. The fact that you're going to have these benefits available. One of the first questions was, is this going to be available on term products? So, Craig, I'm sure you found out that as you sat through the presentation, yes, all of these benefits are available on all of the life policies that are issued by American General Partners. Speaking to that, American General Partners is a separate entity from your American General contract. So, if you are appointed with American General, you still need to go back to the Messer website. Again, go back to our Agent Resources tab, to the drop-down box Contracting, and choose the American General Partners tab and take that contract and get that started. It's very important that you get that contract going, that you get that appointment so that you have access back to the website. The interesting thing is you'll go back to the same American General website you've used in the past if you've used it, and you'll find in the bottom left-hand corner your access to all of the AGLA, that's what this will be representative, the American General Life, and you'll be able to open up that screen and not only work on presentations if you choose to, because there's an abundance of information. Walt overwhelmed me with his last visit, showing me all the tools we've got out there that you can use to learn about life insurance, about selling it, but also in this case to narrow it down and work specifically on that client. Get the information on the illustration. Call in to us for assistance if you need on the illustration. Also, of course, American General Partners are available. Let me tell you, they're a wonderful group to work for. They're headquartered out of Tennessee, so it's a little different than working with the Houston group. Again, Walt sat with me last week, and we had a call regarding a couple of policies that were being run through underwriting. And we had a great time, and the lady that was there didn't even know Walt was in the office with me, servicing me and servicing that agent on those policies. So look with confidence that that can be done, and that'll be a great asset to you and your business. But then again, too, the last point I want to make here, and why I want you to go to that website and get your appointment done, is so you can take care of your training certification. There is a requirement that you review on their website basic information like Walt just actually reviewed with you today, so that we can get you accredited so that you're able to sell the product. So very, very important. Walt, also for your information, ladies and gentlemen, will be with us in September. Hopefully you're planning on attending our expo on the 12th and the 13th here in the Charlotte area. And at that time, you'll be able to meet Walt personally. He'll be manning a booth for American General Partners. He'll also be doing training classes. So again, you can go back in and get some refresher. Or perhaps when you're talking to other agents, you can get them to come on in and get the information that they're going to need to use as well. I can only emphasize again, as an agent out in the field myself, the importance of having this type of a product available to you. It's the new insurance. It's the product that you can go back and talk to anyone that has life insurance, the old-fashioned way, and show them how they can benefit by transferring now into this life benefit program, the quality of life, and it'll go back and reinforce the things that really have started to disappear. The fact that there is an opportunity to have return of premium. Ladies and gentlemen, if you're out there working on clients and you're looking for that, it's very, very hard to find. It's almost completely gone. So again, the benefits that are outstanding, the fact that you've got chronic and critical available to you, Most people are somewhat familiar with the terminal illness because you've had that on other policies. But again, very important point, they don't have to have a minimal window. As long as that window is 24 months, that's an extremely beneficial opportunity to enforce that type of an option. And let's see what else we have. Oh, we have just an interesting comment from Marvel. He's saying hello to everybody out there from the Philippines. So I guess he's enjoying himself this morning as he's on our webinar. Thank you very much, Marvel, for that information. Walt, I don't think I have anything at this time other than the last point to all of you. As always, Messer would love to see you bring in that first application, get it into us here in the next 30 days. We'll get that into the system. Make sure, though, again, you get that appointment and contracting work done so you can be certified. Even if you get an app in before you get that certification done, they'll work with you on that. But, of course, that's going to delay the processing. So try to get that done in advance so we're not hung up out there waiting for you to get the certification and the approval. But, again, it's always, yes, go ahead, Walt.
And let me just add on the certification, it's really not a big deal. It'll take you about 30 minutes. And, you know, all the information I covered on the accelerated benefit riders, that's pretty much what it is. You'll go through that stuff again in more detail, of course, than what I covered in this brief period of time. But you can get through the whole thing in 20 to 30 minutes. It's no great deal. And you'll also learn something. And the other thing I might add is that once you get contracted, you know, each of those different elements I talked about today, we have done webcasts in the past on those, and those are all archived on our website. So if there's anything specifically that you're really interested in, you can go find a webcast we did about it and watch it again and get more information. And you can always call our sales desk. They'll always answer any question that you have. So I certainly appreciate, Mark, your help with this and everybody's time.
Well, it's again, I think it's the best product out there today. I think it is, you know, like the sliced bread. It's necessary, and I hope that the agents can put it under their belt and run with it. And I think you'll be able to satisfy more people than you would have before, because now you can sell one product, important product of life insurance, but add the additional benefits that normally you may have sold as separate policies for those chronic and critical illness cases. All in one, ladies and gentlemen. Again, with all of that in mind, I thank you for your time this morning, and I look forward to your joining us again next Wednesday. Same time, same station. Walt, thank you very much. And everyone have a great week.